Welcome to the Twomey Stock Market Report. I'm James Twomey, and today is March 12th, 2023. Well, we seem to be having a lot of these conversations, aren't we? And as my subscribers know, this has just been one of those weeks that when events happen and they catch up with you, it really raises havoc on the stock market. So let's go over this weekly report on March 12th, 2023. It's Sunday, what to expect Monday, Tuesday, and Wednesday, and then how do we trade? What's happening? We look at things both short-term and long-term. Here at the Twomey Stock Market Report, we analyze the economic fundamentals of stocks that we choose or look into, sectors that is, and then also we look at the technical indicators. We use those as our guardrails so that when we make sure that we don't either override our premise and it becomes a bias, and then we also use those technical indicators to help us understand the direction of the market, mostly from a short-term perspective, because a lot of traders and algorithm trading is based off of these technicals at certain events. When I say event, though, when certain technical indicators kick off. And of course, every day there seems to be another one added to the list. So we take them all and then put them into a basket of goods, almost like an ETF or a mutual fund. And we use those to boil down to a very technical directive. And then we marry that with our economic indicators and come up with some very interesting insight. And that's the Twomey Stock Market Report. You can go to the website, TwomeyStocks.com, and you can simply pull up our front page, and there you'll see the link to the weekly newsletter. And of course, you get all the insight that we produce, and that will be up shortly for those who'd like to take a look at it. We also post some of our videos on the weekly segment, as well as some updates to the market on the front page to kind of keep folks abreast. And then for subscribers, you can sign up for, as they know, or as subscribers, you have trade alerts and key training videos sent right to your email and desktops. So let's get into the weeds of what's happening. Very simple. Thursday and Friday, what happened? SVB, two banks collapsed. One was crypto-oriented, and the other was Silicon Valley Bank, which lends most of their money to high tech and startups. They were part of DoorDash. I think Facebook and Amazon. They had tremendous history in helping startups get up and running, and they funded. One thing unique about SVB that the Federal Reserve FDIC took over on Friday was that it had plenty of deposits and plenty of assets. What happened was two things. One is they cater mostly to startups, and venture capital funding has dried up. It just is. We've been talking about the appetite and risk, and we're trying to, where is the collapse going to happen, right? We certainly saw it in crypto, but we don't trade that, so it was sort of on the back burner. We didn't really expect that to be too much of a contagion because it's really limited into that sector. What happened though here is, since venture capitalists and hedge funds, a lot of money is drying up, these startups who need cash to make payroll, buy equipment, make investments, do R&D analysis. They're constantly raising money to handle operations. So they go out on the road, they raise money. In addition to that, they lean on SVB or similar banks, mostly regional banks, to get their daily funding money. And that's what they did. Unfortunately, the SVB, two things happened. There was a kind of an increased need for these companies to have cash on hand to meet obligations, short-term obligations, and they weren't raising the money. So SVB was stuck with trying to fund them as best they could. And what they did was they had quite a bit of their holdings and assets in long-term bonds that were purchased back when the interest rates were near zero. What does that mean? Well, in order to raise capital, they would have to sell those off And usually they can sell them off on an orderly basis. Most banks do, anyways, as a common practice. But what happened was they had too many in that short term. I mean, if think of it this way: if you get a bond that's 0.5% and it's for $100, right? And then and it's before maturity, before you get your $100 back at the maturity, and most of those they held very long term. Bond years of duration. So what happens is I need to sell that $100 bond. Well, Harry down the street goes, I can get it from Synchrony Bank or Wells Fargo or whatever. That same $100 bond or CD or whatever, I can get that, and it's going to give me 5%. So for a year. Right. So why would I buy yours at 0.5 for the next 20 years or 10 years or whatever the length that remains? So SVB says, well, geez, Harry, I'll tell you what, I'll give you, just to take it off my hands, I'll give you at a discount. And the discount will bring it into like 4.25% or something of like that over the life of the bond. So you're really getting a pretty good deal, because who knows what interest rates will be 5-10 years. It's a long way of saying they have to take less money for that mature bond that they would have held to maturity for $100, and they have to sell it for 90 or 95 or whatever it is. Well, you do that with billions of dollars, it's a real big haircut. And this graph, and I don't know if we can get it a little bit bigger, but the net of it is, this is, is this a one-off? And that's what you're going to hear. All the pundits, all the, whether it's the Janet Yellen or the government or the Federal Reserve, whoever's going to come out of the banks, they're going to march out all these stellar people the next several days. This is a contagion. No, this is a one-off. We got it's a very specific bank, and we're going to go over more detail on that. And they're going to kind of, obviously they're saying, circle the wagons. Let's not have this become a Lehman Brothers or a Washington Mutual fiasco, the tip of the iceberg kind of thing. So of course you're going to hear nothing but good things. So what it's going to do is provide traders a chance. It might give a bounce in the market or keep it flat. People can kind of get out before the next downturn, right? I mean, the last 2 days are just devastating. So and while we're on that subject, what happened was, let's see, the Dow closed 4.4%, the worst weekly performance since June. This is the week performance. S&P 4.5%, Nasdaq 4.7% drop. Russell dropped 8%. Year to date, Dow Jones is 3, the Nasdaq 0.6, the Russell 6.4, and 0.65. Nasdaq 6.4. So we've got some, really negativity going on there. Anyways, what's happening with this graph is, if you look at it and you pull it up in a market report, all these things in gold here are available for sale. Securities available for sale. The darker blue is held for maturity, and this is billions of dollars. So this is from FDIC, and they're giving the bank security profile, right? All this is saying is, in this dark blue, there's billions of dollars, 500, 600. Look at these. And this goes up to 2022 to near 2023. These are all these long term, if they held to maturity, billions of dollars that they can't roll off without taking a haircut. So we've got a lot of money out there. And as common practice, is this normally done? Yes, but it's done in March. SVB was just mismanaged. They had way too much of it into this. They didn't roll it off fast enough, and bigger banks manage that much differently. So that's where we are. Is this a contagion or a one-off? Regional banks all took a hit. They were down. Let's see. We had multiple of them had stopped trading. Let's see, First Republic, PacWest, and crypto-focused Signature Bank and First Republic all dropped 14.8%. PacWest at 38%. Some bellwether bank stocks suffered similar losses. Bank of America fell 4%, Goldman Sachs similarly, and 4%, and then Bank of America fell 1%. JP Morgan held a gain of 2.5%, and Schwab dropped 17%. There was a big bank of J.P. Morgan had a block of 650 million pre-market Thursday on ready to sell, and Schwab's a big bank. They've got a lot of capital. They got a lot of assets. They managed money very well. Is why that was. Did SVB or some other regional banks have money in short-term duration or long-term durations as Schwab, and they needed to liquidate, or SVB was trying to liquidate all kinds, millions and millions of dollars wherever they held, may have had it invested. So they, who knows how that tracks, but this is the problem of contagion. Is it a contagion or a one-off? Now you look at who did they lend it to? I mean, that's the other issue. Roku has $487 million in cash and cash equivalents in uninsured deposits at SVB. If it's uninsured, they can't get it until the auditors come in, and there should be enough assets to pay everybody off, but it's not going to be for next week's payroll, right? And then it's only 250,000 was is FDIC insured to be available Monday. That's not enough for a big company like Roku to make their payroll. So we've got all types of firms that have borrowed money. One founder was asked who remained anonymous on CNBC, who said everyone is scrambling. He's spoken with over 30 other founders, probably small companies, startups, talked to finance chief from $1 billion startup. They all tried to get money out of SVB, and it wasn't available. By Thursday, it was kind of pretty much shut down. Friday was illiquid, obviously, right? Another company with 250 employees told them that SVB had all their cash. They don't know how to operate. Esti, one of those, online where people sell their products, was having trouble getting money that people, you buy a product through you have a website, it's through Esti, somebody buys the product, you're supposed to get cash for that in your account, through credit card transaction. SVB was in the middle of that, boom, they're not getting their money. I mean, the trickle effect is just amazing, because look at all the money went into, and all the startups were founded when the interest rates are near zero. So we've got all kinds of, more shoe to fall, more to fall. Already they're calling for the Fed to cut 100 basis points by the end of the year or sooner, and this is just going to be, unbelievable rhetoric the next several days. And I just want to bring up a chart. We're going to go to the S&P. We always look at historical data, and we go back to Lehman Brothers collapsed in mid-September 08. Washington Mutual was the 25th in 08, and Lehman was September 15th, 08. So they both happened in 08, right? And in around September. So let's take a look. What was this is a monthly chart now, so bear with me, because it's not granular to the week or the day, but it gives you an idea. The markets really, this is what I talk about, circling the wagons, right? That was kind of the beginning of all this debacle for the financial crisis. So here, I put it circled there. Yeah, September rebounded, maintained, and then not until October, November, December, January, and then February of 09 did the market bottom. So we had 4 or 5 months of heavy selling. And we've talked about this. If we go to the daily chart, we had a nice rally up off the lows, here back in October, and we have a lot of people still holding stock. And we were thinking of maybe a sideways market at best the next several months or the rest of the year based on the data that we were projecting. We came off the premise that markets were run up to April or May, and that we were looking at sideways action. Now that's all negated. And if we look at, this high volume, look at the volume of selling there. You can't see it probably here, and it's a light color, but right where my cursor is, that's a high amount of volume on Friday. And is that capitulation? No way, because if you look at the weekly chart, even though we came down quite a bit, the volume, it still hasn't hit highs of back in May and June, and then certainly not even as low as when we were at the after the bear market rally, and then the lows in October. So we've got more selling ahead, or let's put it this way: we have more people holding positions that, you know, if fear comes along, they'll have time to sell. So our game plan is this: short term is to get onto an ability of any market bounces to kind of liquidate what we had. Uh, we did have. We'll go over our trade track. We did have some stocks that our first and second, third positions kicked off for nice profits. So we're out of those, not 100% out of those positions. But there's any winners we're keeping. Any ones that are floundering, we're going to have to take a haircut and get out because more economic woes ahead. If you look at the economic, U.S. economy added 311,000 non-farm payroll jobs, and they were expecting 225. Once again, we can't seem to have any data that meets any expectations. Nobody knows what's up, what's down. Everything's a surprise. So, SVB was a surprise. I mean, it's like who's got their hand on the wheel? We can't. Basically nobody, and that's a shame. And we're trading and we're investing in that kind of environment. So, it's too bad. But anyways, what does that mean? It means, with more jobs, the Fed is trying to keep employment at a level that they can feel that the economy is not overheating. This sends the message the economy is still overheating, puts pressure for the Fed to have to raise rates. And, raising rates only does one thing. There's no economic stimulus. There's no money. Washington is still spending money like a drunken sailor. They're still, got all their pet projects they want to invest in and grow that aren't profitable. There's too much giveaway. There's too much money sloshing around between the stimulus and the aid bills that came out over the past several years. So where there's a lot of money, there's a lot of inflation. Surprisingly, though, unemployment went up 3.6 from 3.4. What's that all about? They said basically it's more Americans entered the labor force, and it was a bigger number. And what does that mean? If you have more people looking for jobs and applying for jobs, you've got more participation. And if they don't, and if people get laid off, and it just the mathematic works out that you get an uptick in unemployment. So people are taking second jobs, retirees are going back to work, high tech's laying off people. So you've got a mishmash of what's going on. So is the economy slowing or is it speeding up? That's the question. I think the economy is flashing signals that is struggling between the venture capital issues that we saw with SVB, these crypto. Pyramid schemes getting exposed. When money starts to tighten up and it's not easily accessible, these things get exposed, right? So that's where we are. We did sell our stops on our first and second, third MGM kicked off for 11.5% gain, or slightly 11.4. That was over a 2-month investment. Borg Warner, we sold our first third, and we're still retaining 2/3, and that's up. It had a gain of 14.7% there for over a 2-month period. TBT, we were 200% short bonds, thinking that interest rates were going to continue to rise, and we were starting to see this as maybe we knew it was a short-term play. We expected it to be more longer term the last couple of weeks, the way things were shaping up. And what turns out, well, the first third kicks off for 4.1% gain over a 30-day trade, and then the second third followed on the same day, 2.7% gain. That's our stops. So we do manage our funds appropriately based on certain indicators and numbers and data that we have. So we preserve capital on run-ups, and we took that over 30 days. We do still hold a third, and we're looking for the bounce and flattening to get out of that trade. Also, our dividend play, Annaly Capital, didn't fare as well. There we took a negative 12% after a 3% dividend. So we ended up netting -9. So we're out of there. That's unfortunate because that's a high dividend yield. May be back. we have some exposure to other funds and some mutual funds that we did lighten up on, but we still hold some, so we're going to have to monitor those. So the conclusion: stocks are technically broke through all lines of technical support, and we're going to go over that now. Economically, fundamentally, we're seeing a slowing of the economy. We're seeing the Fed now in a pickle of having to raise rates, and now we're seeing the first signs of banking issues. And if we look back to the financial crises, 2007, 8, and 9, the first couple of banks, everybody circled the wagon and said, oh, it was a one-off, but it was a much deeper issue. This credit risk, it's hitting Europe, it's hitting us. SVB's got a big footprint, 16th largest bank. There is a big footprint, but it's a more underlying issue of the industry they play to. And if that industry is struggling, that is, and we saw it in the small caps, got obliterated, and that was kind of leading the charge down. These smaller companies, if they have to, in order for them to have money, they have to go out and give unwieldy returns for people to invest their money. Right now there's no appetite. You go out and buy a 1-year CD for 5.1% and call it a day. And if that starts coming down, people are going to race into them even more, and that will even drive the yields down further. So that's an interesting fact. So let's just go through our technical basis here. We do every week, and that was our opening salvo. I think it's important we cover it just to give people a background and some history of where things are going. But we look at the equity put to call ratio, and Friday, no surprise, it closed way up, 1.11. Very bearish, right? And the bank collapse, high jobs report, inflation versus liquidity sent investors and traders to the selling windows, and no surprise there. We look at our advanced decline. I look at this as much more of a bigger picture because New York Stock Exchange is a big breadth of stocks. There's plenty of them in there, and it does give us a bigger picture of what and the health of what these stocks are doing. And they had been above their 50 and 200. We looked pretty, pulled back a little bit, but the MACD and RSI was kind of indicating things were flat to neutral. Well, broke through the 50 and the 200 EMA, in a matter of a day, and that day or two, and that is a rare event, because there was enough gap between those two technical indicators. And in addition to that, basically went straight down. We've got an RSI that is pretty low, heading there, oversold, 32 from last week's 55. The golden or the bullish cross stayed in play with the 50 over the 200, but that's narrowing that gap. We also saw the MACD drop pretty low into negative territory. So what is that all telling us? It's saying, hey, short term this might be oversold event, and we should get a bounce. We're hoping for a bounce, right? All I can say is history usually says these things get worse, and there may be a little bit of a reprieve, and then selling comes in mass because nobody wants to hang around. And I think there's still a lot of pain on the last bear market that people are just not going to hang around, right? Not for round two, anyways. So this is telling us also that only 44% of the stocks are above their 200 moving average. It was a high of 71 several weeks ago. Last week it was 63, I believe. So a rapid decline. For this chart to show that means everything's being sold. So that points us to, we look at the RSI index, oversold. We look at, low 30s, mid to low 30s as oversold. And we look at, when we start eclipsing near 65 and above as it's overbought, and then we expect some kind of reversal on either a stock or a sector or an index. Well, SPY is at 35, Dow's 31, NASDAQ's 42, Russell's at 29. They are all in sell signals. We've been in that way for several weeks. In addition to that, that low numbers for the Dow and the Russell are indicating, they're oversold. Will there be a short-term bounce? This is one of those things where RSI is going to be less of an indicator. The short side, we're all up in the high 60s for the S&P and the diamonds. The NASDAQ is, room to sell off there at 57, and the Russell's up at 71, well into oversold conditions. That's telling us that there's more, there's a chance that, the selling will abate. Anytime you have 2-day rapid selling like that, it's hard to say. I mean, it had a panic-like feel, but we're nowhere near, you know, we're nowhere near a situation where it's capitulation. There's more to come. So the RSI is indicating, maybe a reprieve. If there's a reprieve, get rid of some of your riskier stocks for sure. There's no sense hanging around. You can always get back in. If it goes up, so be it. If you want to retain 20%, 30% of your position, and you have the ability to risk that, as long as you're countered it like we have. We've countered with CDs and I series bonds and some other things to, at least know the next 6 months we're going to get some capital, right? We look at our sector table. And this is all in our reports and our weekly updates and our alerts that the subscribers get. But anyways, there's no place to hide. We filter this for by 1 month high to low. In this case, I did the reverse. I did low to high because just how dramatic it's gone. And down here, consumer staples, industrials, and information technology are the leaders, and they're -1, -2, -4. So not really. There's not a lot of places to hide, right? There's just and you look up here, real estate, financials, and energy that's why I kind of did it reverse this week, because what's going to happen? Anything to do with lending, credit, it includes real estate. It's all going to get obliterated and sold off. Nobody wants to have their money invested in places that may be at risk. So no surprise. Energy, that's just simply less demand, less energy use. We go into more detail in the economic, environmental economic indicators, not the environment that we live in. It's the environment of, what's happening globally, taxation, government, that type of thing. That's how that affects our trading. And it's been basically flat for a couple of weeks, albeit not returning a lot of money. So no place to hide in this sector table. We talked about bonds, and we can go over that right now. It's just the tail of the tape. We'll look at TLT, which is long Lehman bonds. That means yields come down. This goes up, and of course, no surprise, Friday, boom, we got a huge increase, right? And that is just about flashing a buy signal. If we get confirmation, we may make that trade. TBT, which we are short, we're holding our last third, and that is, hit the 200. It obviously, to reverse this, these go up as yields go up. So if your bond yields go up, which they skyrocketed a week ago, surprise, surprise, because everybody. But anyways, the net of it is that is dropping. It is right near a sell signal. This cascaded down in 24 hours. So, and of course, it's a 200 leverage 2 times. You're going to get a lot of pain on that. But we got stopped out. That's why we have our stops, and we did pretty good on getting some short-term gains for 30 days. So that's what's going on with bonds. We talked about oil, USO. Let's take a look. We'll kind of go through this USO. That has been pretty steady. This is a daily chart again. We've kind of leveled out here, and no surprise, the barrel of oil that the White House is the economic in charge at the administration said they were going to start refilling the strategic reserves. It's been kind of held quiet. They pulled back that purchase, and I've been trying to see if they have actually made purchases, and lo and behold, we're getting kind of a steady sideways trade on oil. Let's see, natural gas, UNG we use for natural gas, United States Natural Gas, that continues to, it was a straight down move. We made a lot of money off it last year. This year we've just stayed away. It doesn't look like that's on any rebound short term either. We're going to go right to the SPY. The SPY is what we use for our technical indicators on a daily basis. Here's the chart. This short term we see, we're back to, since February, lower highs, lower lows, and that continues. We had the 2-day major sell-off due to the banking collapse, and this is serious business, folks. There was a high volume of selling. We expect more to come. We had targeted, and we're going to go, and I'll show you the comparison. We had looked at, the December lows as being the first kind of target if things went south. And we were expecting more of a sideways move because we had it's going to be hard here. Let's just pull some of these out so you can see. We had the 50 here in the pink, and we had the 200 all acting as support over these several weeks, several days here, a couple of weeks. And, we expected if the technicals were going to be influence of stock prices and sentiment, that it would hold, especially with the 50 getting ready to cross above the 200. Well, unfortunately, it didn't. All our short-term ones, the 20, the 15, and the 9 EMA, they got blown away as well. And so we have no technical area of support, but of where things traded last. And Fibonacci, since the lows of December, we're at 3/4 the way down. We're only 2.5% from hitting those December lows. So this is sentiment is burning towards that as our next stopping level. I'm not in the prediction business. Will it hit that? Will it go in there? It hadn't looked like that was going to come in play, but we said if any major selling, that was going to be the next stopping point. So we'll see. And the reason why I say that, we look for the diamonds, which is our proxy for the Dow Jones. And, that was pretty much sideways, a little negative sideways move. And we were like, well, the December lows did get broken last week, and then it rebounded from there. The 50 still remain above the 200. Like if the Dow Jones is kind of being the predictor, everybody went into the high tech sector because that was beaten down and they thought it was safe to come in. And, it's still up for the year. But, anyways, what we're seeing here is, a little bit of an issue. And that is the Dow broke down quite a bit. It went past the December lows. And now we have to worry about, is this going to target the bear market lows back in, October of 2022? It may. I mean, if we look at from the bear market lows, Fibonacci retracement, it's almost 0.5, 50%. The stronger that retracement, if it breaks the 0.5, we probably go to 0.6, or 61% or 0.618. So, and if we did get to 0.618, there's really not a lot of support there. You don't get the support until you get down into, maybe the lows of June and July, right? So there's a lot of technical indicators breaking down, showing that markets are definitely on the retreat. If you look at the NASDAQ, QQQ, we look at these indices to just get a feel for, the overall market. And you can see that's still, the 50 never got over the 200. We're below both 50 and the 200, these technical indicators. There's the 50. And, it's not, it hasn't, it's same as, as the SPY. It's a little less than the SPY, is near 0.5 Fibonacci retracement from December lows. It looks like it's lower lows, lower highs. I'm surprised it didn't take a bigger bath. But if these startups or these high-tech companies really start to flounder because of credit crunch, then this is going to drop dramatically. I took some short positions over the last week or so. I didn't provide that to subscribers because we weren't convinced that the entry point was good, and it's one of those things. But any long positions that we're in definitely took a haircut. So let's see what else we look at. We talked about Borg Warner. We were in Borg Warner. We took that first, third, second, third profit. This is the daily chart. It had already gone back up to our February 20 or January 2022 high. So it had gone from the lows back to the highs, and now it's on retreat. We're probably in a sell signal if things continue, and we'll get rid of the last third. But we got in way back here in the early part of 2023, so we enjoyed 11% there. Gain on the first and third. Then MGM was our other high flyer when you think about it. And that's the same thing. It's near a sell signal. And MGM, we've got, let's see, MGM. Borg Warner, we still have our second 1/3 that will probably kick off tomorrow, and then we have another third that, if we hit that sell signal, we'll be getting out of. So it's we hope to get out of this with another 10-12% on the final 2/3. We said MGM we have 1/3 left, and we changed that stop. So we've actually brought that stop into play versus waiting for the sell signal. But subscribers be on alert. We'll probably get something out the next day or two, depending on where this market goes. And that's at 12.6, and we got out at 11.4 on our first and second third. Plains American Pipeline is holding well, and this is one that we wanted to add to if we could. If we get into the 11s, let's see where we're at. This is our dividend play for energy, and that is near a sell signal. It is closed at 13. No, 12.8. Didn't make 13 on the close. It's near the 50. We expect this to come down. Probably get in around the 12. And if we hold there, that's great. If it gets there, we probably want to start adding. I said add if it's 11.8 or more, and that's an 8% dividend play. So we're still with that. JEPI, the Morgan Premium, that's usually a pretty good dividend stock at 11-12%. We get stopped out of that. We got there's no sense hanging around these kind of financial plays. The enterprise products, that's another energy play with dividend of 8%. We're in there, and it's still holding at 1.12%. Annaly Capital, we took a bath on. We got out at 13% loss there, but there was a dividend up there, so we have some chances to hopefully come through on that, back in the future. So we'll see if that does come back in the future, and if we can, we will get in there and make that back up. The TBT we talked about, we took a 4% and a 2.7%. We still hold 1/3 for it's negative 1.5% there. So as you can see, we're dwindling our plays. There's less and less available. Our equity mutual fund, that's mostly dividends, that's down almost 6%. We got only half left there. Small caps, no surprise, we're almost down 5.7% there on the last half we hold. Technology, we're still up a tad, and then of course the S&P is down -3. So the mutual funds we like to hold on as long as possible. We only like to enter those when we feel the market's safe for that. This is one of one's second time in a row that we're going to have, may have to exit it before our target dates, which is really interesting. We bought CDs. We bought the CD Charles Schwab Bank, and that is offering 4.9% annually. We bought the 6-month version of that, so we get 2.45%. And then we're also in the iTreasury, which is offering 6.89 at the last November series. So, those are long-term investments that we have our subscribers, if they're so inclined to take. We want to at least be trading our behavior now is going to be trading short term, and then we're going to try to look for things like a Borg Warner. We're a sector that's going to start. There'll be sectors and more defensive sectors probably that will start to surface, and there you might have some things run up. The industrial sector is still doing pretty good. XLI, let's take a look at that. XLI is we've been in and out of that. That took a hit for the first time, and see how that was an upward flatness really since December of 2022, and that was kind of indicating of the Dow Jones and other industrial S&P sector is still kind of holding and not dropping like a Borg Warner, and other things. So that may have a chance to rebound. It's heading towards the 200 EMA. If that doesn't hold, then all bets are off, and I think you'll have even more selling. So that's our conclusion at the Twomey Stock Market Report. A little bit lengthier dissertation today because of our opening. We urge caution for all short-term traders, long-term traders. Take advantage if you can get into these CDs before they start dropping, or munis or treasuries, depending on if it's taxed money or IRA money. And there's no there's no, took some of the short-term ones because we didn't think rates would, stabilize. That they'd kind of tick up, so we'd have a chance in the 6-month rollover to get some more. Um, we had some short-term treasuries that rolled over, and we kept them short-term. So that's the nature of the beast. Why take risk? And then we'll look for the stocks, any ones that we can look on a short term, especially if they kind of fall in. We were hoping everything would have. Hope is not a real good trading strategy, but it was looking like things were going to kind of fall into a sideways, and they still may. A fairly large sideways pattern that you could trade, with the lower end of that sideways trading range, and then buy then and sell at the top, and you can usually get a nice fast buy and sell signals that you can make some short term, some nice quick hit trades. But right now it's way too risky. The VIX is starting to kick up, the volatility is kicking up, volume's kicking up. Volume can be your friend, but you have to be very quick on the trading finger. If you're so inclined on any rebounds to short some of the indices or stocks, that's probably not a bad thing to do. I'm James Twomey. Any questions, reach out to me at info@TwoMeStocks.com. We'll get right back to you. And of course, go to our website, the number 2MEStocks.com. Enjoy your week. I'm James Twomey, and this is the Twomey Stock Market Report.